that's always not good to see on a stock if you are long-term bullish.
Okay. So that needs to be kept in mind. With that, we have Veer's query with us. He has written to us from Mumbai. He holds 1,000 shares of Ujjivan Small Finance Bank at 36 rupee a piece, and he's looking for a long-term view on the counter. So the small finance banking space, Prashant, as compared to the other PSUs, so how optimistic are you about this space in particular? And if I talk about Ujjivan Small Finance Bank?
See, I was very much negative on the overall space in terms of the small banking finance. But again, this stock has really done better in this space. Maybe the reason would be the way how RBI has given so much of liquidity in the system. April, May, June, all these 3 months, we got a good interest rate cut. And I think they got a good liquidity to push credit growth as well as loan growth in the smaller scale. So I think Ujjivan's finance is doing good. Please maintain a stop loss of at least 42 rupees from the current levels, and then have a long-term outlook, at least for 55 to 60 rupees for next 6 months to 1 year.
Right. Thank you so much for that. And Sarvendra, quickly, I'd also like to take your view since Prashant is not optimistic about this space. So firstly, what is your outlook in the small finance banking space? Secondly, what are your recommendations if somebody has invested, in the space in particular?
Yeah. See, you have to also look at, when you're looking at banking, you cannot ignore Bank Nifty. So you have to also look at Bank Nifty, and the very fact that Bank Nifty has been underperforming Nifty over the last 2-3 years in terms of overall percentage returns, and Nifty has been outperforming it, and the whole margin is last 1.5-2 years is a huge time span where Bank Nifty is not able to catch up. So I would say that within the larger scheme of things, I would see this as a negative sign for Bank Nifty itself and for the markets as a whole. And my sense is that this stock topped out in 2023, did not participate in the 2024 bull market, kept on falling. It's only now that it is pulling back. So I would say within the long-term scheme of things, looking at the stock and also at the Bank Nifty, I would qualify this move as a bounce. You've already retraced around 65% of the previous decline. My sense is that incrementally no longer you don't have a very good risk reward on the long side. So I would advise him to exit somewhere here or maybe next 10-15 days, and possibly keep some dry powder and look for opportunities in the next 3-6 months.
Okay, thank you so much for that. Now we are joined by our first caller on the show from Bengaluru. Hi Pradeep, good evening.
Good evening, ma'am.
Yes, how can I help you today?
Yeah, I'm holding, ma'am, 300 shares of DCB Bank.
Okay.
Purchased at 143 rupees.
Yeah.
Right. So it was languishing much below my purchase price for long. But recently it has made given some rise. So I wanted to know whether I should hold it for a long term, say, of another 2 years.
Yeah.
Or whether I should book profits at this stage.
Okay. So, Prashant, DCB Bank, like we are talking about the banking space, if I look at the valuation, that is extremely attractive. But as compared to its peers, do you really, would want our viewers to go for a DCB than an HDFC or an ICICI Bank for that matter?
So we can't compare the bigger, larger banks with DCB, because obviously DCB has done very well in the last 2-3 months. Despite we have seen how SBI, HDFC has not outperformed in the last 3 months. For me, again, valuation looks very attractive. And as I said, RBI has given a lot of liquidity for the banking system, which these banks are getting utilized very well. So for me, at least this year, I would like to see PSU banks and the two smaller banks to perform very well against the larger PSU banks. So I would like to advise him to hold at least for 160 as a target. And as and when he gets the target, there will be time to book profits.
Okay, so Prashant is quite optimistic about DCB Bank. And with that, we have a caller joining us from Bengaluru. Hi Ravi, good evening.
Yes, good evening, ma'am.
Yeah, how can I help you today?
Madam, I want to buy dynamic cables.
Okay.
So, may I know what is the right price, entry price?
Dynamic cable.
I want to hold it for 2 years, yes.
Okay. So,
for a 2 years period.
Understood. So, Prashant, currently it's trading at 444. And if I talk about today, so it was down over 6%. So, what's your sense holistically? How are you viewing the counter? Is it an attractive bet?
See, cable as a sector, I think all the bigger players are doing really well, but I doubt this company is not so, in terms of its quarter-on-quarter growth. But with respect to price action, I think the stock has rallied very well in the recent times, where there is a mismatch of growth with respect to price action. So for me, this would not be a right time to buy, but I think wait and watch for a good level. That level can be 375 or even 400. That can be a right level to start accumulation, but time being, don't enter in the stock.
Okay, okay. Thank you so much for that. We are joined by Surya on the phone line from Hyderabad now. Hi, Surya. Good evening.
Hello, good evening.
Yes, how can I help you today?
Actually, I have about BDL with the price of 1810.
Yeah.
I have about 100 shares.
Okay.
So I can see Motilal Oswal given the neutral rating for this one. And they have given price target 1900.
Yeah.
So from that day onwards, it is falling daily. So is it the right time to stay in this one, or can I exit?
Okay, okay. So Sarvendra, I'd like to come to you, on this query. So the brokerages have given a much, higher target price. But how are you viewing Bharat Dynamics, and what are you anticipating looking at the charts?
See, all consensus buys and darlings, this stock belongs to that space where it was in flavor, and kudos to it. I think it's put a new high lately. When the markets, the Nifty has not been able to put a new high, this guy has gone and put a new high there. I think the best of the risk reward is already in the price. So I would suggest him to wait. The stock looks very overbought. Could give you a very decent correction. So you'll have to wait out, and over the next 1 or 3 months, you have to wait out and see what all downsides this stock can do. Right now, I think the long-term 200-day marker definitely is doable. So a correction going back towards 1470 right now, the market is at around 1470. So I think that much downside definitely is pending. So I would advise him to wait out for some time and then get more clarity. For the next 1-3 months, we'll get more clarity. We'll be able in a better position to tell him what to do. So wait.
Okay, so wait and watch on Bharat Dynamics is what Sarvendra is suggesting, and you can call us again after looking at the counter for like 2 to 3 months, and you can read up about it, and then you can come back to us and ask away your question. Now we have Sanjay joining us on the phone line from Thane now. Hi Sanjay, good evening.
Good evening.
Yes, how can I help you?
I have a query regarding NCC. I already have some shares. I was looking for advice whether I should add on at the current prices for a 1-year horizon.
Okay. And you bought it at 225, correct?
Yes, around
is it a recent purchase?
Yes.
Yeah, because it's hovering around the similar levels.
Same.
Yeah. So Prashant, Sanjay wants to invest in NCC for a long-term perspective. So 229 currently it's trading at these levels. So are these attractive levels to accumulate more? And are you optimistic on the counter as well?
Yes, very optimistic on the infrastructure space. Again, EPC is my favorite sector for next long-term investments. NCC is again very attractive with respect to valuations, trading at a very 12 to 15 forward P, and even price to book valuation is below 2. And the order book is really having a 2 to 3x of its recent full year revenue. Even in terms of price action, I think last 4 months, the stock is very much in the consolidation phase. So a good level to start accumulating. Every dip has to be bought. Again, obviously, as a long-term investor, I can have a very clear target of 280 to 290 for next 12 months.
Okay. So thank you so much for that view. And also, I'd like to take, Sarvendra, your view also on the counter. So what are the charts looking like, and what are the key resistance and support levels that you're seeing on the charts?
See, he has to keep in mind that the stock first topped out in 2008 and could not put a new high and could not participate in the bull market, making new highs into that entire run that Nifty had from 2200 to 26,000 that we are here. But yeah, lately it took out that number around, I think those numbers were around 235. 2008 highs were around 235, 236 adjusted. So it took out those numbers now. Again, it's come back, went back below that number and again back at that number. So that number is getting whipsawed right now. 230, 220, that area I think should be very, very important for the stock. Right now, as we talk today, we are above those numbers. So I would say that yes, at 180 lows that we printed a couple of weeks back. Possibly there could be a medium to short term bottom. And he was saying that he wanted to average. So I think averaging a good price would be around those levels, 180, 190, that area. If at all it again comes, I think he can possibly look at buying at that point in time. But whenever he's adding fresh positions, he should be keeping a stop loss, and that new trade the next trade that he takes, he needs to keep a stop loss at 174. So whatever he's buying at around 180, 190, he needs to keep at least that much stop loss at 174. Because suppose for some reason it is going back and staying below that 2008 number, then there could be a disappointment going in next 9 to 12 months. But yes, over a slightly long term, 2-year plus kind of a horizon, I think technically also the stock is nicely placed. So he has got a good trade here.
Okay, Sarvendra, thank you so much for that. Now we are joined by Mansingh on the phone line from Andhra Pradesh. Hi Mansingh, good evening.
Hi Makshi, good evening.
Yes, how can I help you today?
My query is regarding Elecon Engineering. I want to add fresh. I want to know the fundamental view and what are the entry points.
Okay.
I can hold for 2 to 3 years.
All right. So, Prashant, Elecon Engineering came up with its Q1 results and they were pretty good. Revenue was up 25%, EBITDA up 41%. So pretty, good numbers there. And especially the growth was led by this material handling equipment versus this gear division. So talking about the numbers that it came out with, are you positive fundamentally also about this counter? And currently it's trading at 607. So are these the correct levels to enter and take fresh positions?
Yes, with respect to the quarterly earnings, you mentioned it, yes, rightly said. The stock has started getting back to its last year average EBITDA, which is around 27-28%. So which looks very good for me for this financial year. So obviously, considering that as an average EBITDA for this financial year, the valuation looks very good for me at this point of time. Again, yes, there is some kind of price correction. I think there is some kind of selling pressure seen in the higher levels of 700 rupees. So I may expect this stock to go back to its 600 or 580 levels. So that can be a good level to start accumulating the stock. But again, every dip has to be bought in this kind of stock and wait for at least for 9 months to 12 months for a great number. My target would be anywhere between 740 to 780.
Okay, thank you so much for that. Now we are joined by Ashok Kumar on the phone line from Bengaluru. Hi Ashok, good evening.
Hi ma'am, very good evening.
Yes, please go ahead.
Regarding, I brought 87 shares for Thermax at price of 4,000 rupees. I am looking review in for next 3 to 5 years.
Okay. All right.
What will be the now?
Okay, so 87 shares at 4,000 rupees. Am I correct?
Correct.
Okay. So Prashant, Thermax is the counter and currently it has dropped down to 3,600 levels from the levels he bought at. But and also he is sitting on a loss of 31,000 is what I can see. So considering all these aspects, do you suggest our investor, our caller, to stay put with their investments, or should they be booking their losses at this time?
Now wait and watch for some more correction. I think today the stock was almost up by 4 to 5%. But I think the stock will again try to come back to its recent levels of almost 3,200, 3,300. That can be a great level for him to average. I am very much positive on the business model on a long-term basis. Obviously, the client wants to have a 2 to 3 years investment in this sector. Currently, again, valuation of 70p and price to book value of 8 times the price to book value. Not comfortable to have a fresh position at 3,600. Buy, but near 3,200.
Okay. Thank you so much for that. Now we are joined by Murli on the phone line from Bengaluru. Hi Murli, good evening.
Good evening, ma'am.
Yes, how can I help you?
Thank you for taking up my query.
It's a pleasure. Please go ahead with your
query.
query.
I want to invest about 3 lakhs.
Okay.
I identified a company called Ashapura Minechem.
Yeah.
Based on his recent income tax relief of 259 crores, which it can set off against losses. Number 2, the promoter has removed the pledge.
Yeah.
3, they have entered into a bauxite also for a joint MOU with China Railway for Guinea.
Yes.
Guinea to market and jointly develop.
Yeah.
And the company, after inconsistent performance during 2021, now it is returning to good growth.
Yeah.
Debt equity is low. With all this, except that some corporate governance issue on the promoter side, which they are increasing their stake, they remove the pledge. It's all the things and it is not very having
Yes,
priced
Mr.
high,
Burley.
it is about 17 P. Can I try that and invest, expecting about 15 to 18% return in a year's time? Year or
All right. Okay, I got your question. Prashant, Ashapura Minechem is the counter, and rightly pointed out by Mr. Burley that the stock is gaining its momentum and is in its upward trend. But what's your suggestion to Mr. Murli and will he be able to make 10 to 15% of profits in 1 year?
I think yes, he has done well, good research on the main points which as a fundamental analyst should look at. Again, valuation wise, very much comfortable to have a fresh position at this point of time. I think the stock is ready to give some kind of great returns for at least for 12 months from the current levels. Obviously, the stock has been trading near all-time high of 572. It may cross very soon in 1 or 2 quarters of the all-time high. For me, a target of 600, 620 can be easily targeted for next 12 months. Yes, quarterly, one should have a watch on this earning shows. I am expecting these numbers to be very much positive in the Q1 earnings. I think they can come back to its 16-17% EBITDA margin. If this is true, the stock will go to 600, 620 very soon.
Okay, thank you so much for that, Prashant. Now we are joined by Ramchandra from Guntur on the phone line. Hi Ramchandra, good evening.
Good evening, madam.
Yes, please go ahead with your query.
I bought 10,000 shares Ramky Infra at the rate of 491.
Okay.
And sold at the rate of nearly 600 rupees.
Okay.
Now can I enter at what time, at technicals, at what I have to reinvest in the Ramky Infrastructure?
All right, so you want to re-enter in Ramky Infra.
I thank your NDTV Profit. As per your advice, I think Dr. Avinash Garu.
Yeah.
And advice of Avinash Garu, I purchased at the rate of 491 and sold 600 rupees.
Okay. So again, you want to outlook on Ramky Infrastructure and for a short-term period, right?
After 6 months.
Okay, 6 months. All right. Sarvendra Ramky Infra is the counter. Currently, it's trading at 623. So are these the correct levels for him to enter and make more profits in the future?
I think he already milked the short-term, medium-term trend nicely, and he's already sold around these levels itself. So there's no point getting back into the same trade until some new development has come. So I don't see anything new that has come here. So there's no case here to re-enter at the same level. But yes, he already has that safety. He already has that levels, which are the safer levels. I think 430, 450, that area from where he bought. I think those continue to remain the main technical levels for the stock. And if he's lucky enough and if he gets it there for the next 1-3 months, he should again try and get the stock around those levels, 430, 450, not now.
Okay. Thank you so much, Sarvendra, for that. Now we are joined by Krishnan on the phone line from Bengaluru. Hi, Krishnan. Good evening.
Hi, good evening. I just want to ask about HDFC Bank. Okay, I have 91 shares purchased at the rate of 1,610.
Okay.
I have profit of close to 35k.
Yeah.
And now I want to know the technicals. Now the bonus also being announced. I don't know what ratio at which they will give, but can we accumulate at the current rate?
Okay.
For a 2 years period or 3 years period. So what would be the price in 2028 or something like that?
All right. So for that, the levels, I'd like to take Sarvendra's view on this. Sarvendra, currently it's trading at 1996. So for somebody who wants to accumulate more, so do you suggest them to, enter at these levels?
The same logic applies here. Since he's bought around these levels, there's nothing called as an average at the same level. So if you want to average, you need at least some. If you ask me, I would always want a 15-20% correction in a good stock. Averaging is not advisable everywhere. So it's a strategy that you need to use very, very judiciously. So, but a quality name like this, if it gets you a 7-8-10% correction also, you might get tempted to start doing a little bit of averaging or re-entry. So I think you need to at least get around a 7-8-10% correction here. 1750, 1800 was the level where it struggled for almost 2-3 years. Since it has taken out those numbers, I think that will be a safe area. 1750 to 1800. If it comes there, then you start averaging and buying more. and try and spread your trade over the next 3-6 months. Buy it gradually. Don't put all your money at once. So do a SIP of 6 months and gradually get into any correction.
Okay. Thank you so much for that. Now we have another WhatsApp query. So Teja writes from Nellore, and he's asking whether he can buy SBI at the current levels, and he has a corpus of 5 lakh rupees, and he's looking for a 15-year view on the counter. Prashant, today only, SBI, we got to know that SBI is about to do the biggest fundraise there, 25,000 crore via QIP. So considering that news as well, and SBI as a strong counter, from a PSU banking space perspective. So what's your outlook?
If the investor is betting on Indian growth story, obviously SBI would be the proxy kind of stock one should look at for long-term investments. Obviously, yes, the stock has been underperforming very recently. At least the stock was around 900 rupees few months back, and then again come back to 780 and 800 levels. For me, quarter-on-quarter growth is really good in terms of expecting. And again, the way I said you with respect to RBI, which has given so much of liquidity, I think being the biggest PSU bank will have a biggest opportunity for long-term investors. My short-term to medium-term, long-term target should be anywhere between 1,000 rupees. Obviously, the viewer wants to have a 10-15 years view. So obviously, it's a very long view. We will be considering if India goes to $7 trillion as an economy, obviously SBI will be the major contributor for this economic growth. So that can be a 1,500 or 1,600 as a target. So overall long-term, very much bullish. Even housing sector, I'm very much bullish for next 3 to 4 years. So obviously SBI being the largest PSU bank supporting the housing sector. So obviously there are multiple triggers for the stock to go on a very good long-term high for next 10 to 15 years. So overall buy.
All right, so quite bullish on SBI, and with that I'm afraid that we are running short of time, but thank you so much Sarvendra and Prashant for always being there and being so supportive, and you always answer our viewers' queries so patiently, so thank you so much for that.
Thank you.
And viewers, with that it's a wrap on this edition of Ask Profit, but we are live in the morning as well as in the evening. So for those who are left today, they can just call us in the morning and get their queries solved. And with that, just stay tuned to NDTV Profit as there's more lined up ahead on the other side.
Right now across the world, even in Harvard is actually realizing that consciousness is a very important principle, and Harvard gives courses on mindful leadership, on conscious leadership, on conscious businesses.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज, और देखती है यहाँ तो सवालों का मायाजाल है। ऊपर से ही अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Benchmarks end almost flat with a slight upward bias. Most indices finish in the green, led by PSU Bank Index as the top sectoral gainer. Small cap and mid cap indices advance for the third consecutive session. The race to insure Tesla cars in India is intensifying, with multiple insurers now competing for partnerships, while Bajaj Alliance and ICICI Lombard have reportedly shown interest in tying up with Tesla. It's an NDTV Profit impact. The NSE has issued a circular warning against unregistered advisory entity named Close Friends Traders following investigative reports that the firm claimed intraday margins up to 500 times leverage and zero brokerage. SBI is in the spotlight for major fundraising initiatives. The State Bank of India is set to launch a 25,000 crore qualified institutional placement. Separately, SBI's board has approved raising up to 20,000 crore via bonds to further bolster its capital base. Commuters in Mumbai face major disruptions on July 16th as drivers for Ola, Uber and Rapido and InDrive launch a strike, leading to cab shortages and steep surge pricing citywide. PVR Inox closes 1% lower after Karnataka's proposal to put a 200 rupee cap on movie tickets across theatres, including multiplexes, and on all language films. In the wake of global backlash over its luxury footwear line resembling the iconic Kolhapuri chappal, Italian fashion house Prada takes a conciliatory step and visits Maharashtra to meet Kolhapuri craftsmen, exploring the possibility of a collaboration. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's take a look at how the markets fared today. They ended flat but with a positive bias after rebounding from early losses. Most indices, barring metal, defense, pharma and finance, closed higher. PSU Bank Index was the top gainer, followed by Nifty Media. Let's go across to Harsh now for a quick wrap of the day's market action.
Well, the Nifty closed as flat as it can get. 25,200 is where we've closed at, and it was a bit of a choppy day of sorts. We fell a bit at the start of trade, and thereafter we bounced back, went towards 25,250, and thereafter fell another 50 points and closed at around the 25,200 mark. So that's how it played out. Around 130 points is the band in which the Nifty traded in. In terms of stock price action, auto did well, and you had an M&M at the which stood out in trade, one of the top gainers on the Nifty. The IT index was the other one, with a decent set of stocks sitting in the green. So that one did well as well. And then SBI led some of the PSU banking counters higher. And the PSU banking index, in fact, was the best performing sectoral index in trade today. So on a day like this, PSU banks really standing out, and SBI on the back of that 25,000 crore QIP that it's set to close is what has driven the PSU banks higher. So that was the larger texture. What the breadth meanwhile within the Nifty 50 remained unfavorable, in fact, and we just had about 20 gainers for 30 losers on the Nifty 50. So that's how at least it played out on the top 50 counters. Now let me take it to the broader markets, and the advanced decline was was decent. The breadth was decent, 3:2 in favor of the advances, but nothing too convincing per se. The Nifty mid cap was absolutely flat. The Nifty small cap just a 1/5% higher. So that's the way the moves were. In terms of losers as well, metals was one pocket, just a wee bit. Pharma was the other one where there was just a little bit of lack of conviction in trade today, but those were two pockets which closed in the red nonetheless. Nothing major per se, but still closed in the red. In terms of BSE 500 top gainers, top losers, some consumption names, a Shopper Stop stood out, a Patanjali stood out. We did see some of the auto names stand out as well, but not within that BSE 500 basket. Some names, some lenders, and Avas was sitting in the red, nearly 2.5% lower. And then you had an Aadhar, which was 5% up. A Mass Financial was up nearly 10% in trade. So those were some of the names as well, which did well in trade.
And now on to an NDTV Profit research special. For years, the large cap IT giants have dominated the market. But there's the definite shift underway. My colleague Sajith has been digging into the numbers, and his analysis shows that mid-cap IT stocks are winning the race. Are mid-cap IT stocks overtaking large-cap stocks? Let's find out with my colleague Sajith.
The IT sector is going through a rough patch, and if you look at the large companies, the two of them have already come out and spoken about a slow order intake, and that's also getting reflected in the revenue market share of these large companies. So we looked at the top 20 companies by market cap of listed companies and the kind of revenue growth they have done from FY22 to FY25, and we found that there is a shift in revenue market share from the large caps to the mid caps and the small caps there. So if you look at the companies in FY22, large caps accounted for 91.2% of the revenue share, and that has come down to 89.5. So 170 bips fall in the revenue market share for them. Mid caps, on the other hand, have gone up from 5.7 to 6.8, which is 122 basis points jump. Small cap from 2.9 to 3.4, and micro cap gaining just 10 bips more market share. But where is this shift happening? If you look at the top 20 companies, the revenue overall has grown by nearly 33% from FY22 to FY25. But the laggards for some of the companies, for the large companies, is basically coming from the Wipro and the Tech Mahindra, because they have been underperforming the large caps and the sector for the last couple of years, and that's what is leading to the fall in revenue market share. At the same time, the share is shifting because it's been pulled up by companies like Persistent and Coforge, and we've seen that in the valuation and the price jump in these two stocks, and that's how it is going. From a revenue point of view, as I said, the total revenue of this cohort, went up by nearly 33%. But look at the revenue growth for the large caps, it's 30.3%. So it's underperforming the overall, 20 stocks revenue pool which is there. Mid caps, the revenue jump is 59.6%, small caps 51.9%, and micro caps, which includes companies like New Web and all, is 121%. So clearly there is a shift in the revenue market cap, and that's what we're hearing from the some of the companies as well, because what we are seeing there is that a lot of new clients are going for companies which are agile and nimble, and where the client can control the companies. Large companies are not able to control the large companies, and that's where there is a shift in orders flowing from large caps to small caps, especially with respect to small discretionary spends and other stuff. So the revenue gain which is coming in is for the mid caps and the small caps.
And a day after the showroom opened in Mumbai, there is already a race between insurers for giant EV Tesla. Sources are telling us that the global EV giant is reportedly in early talks with Bajaj Alliance and ICICI Lombard for potential car insurance tie-ups in India. My colleague Agni brings us more details on this.
Tesla might have entered India, but the bigger question that people are asking are who will be the insurance provider for the company. Sources tell us that Bajaj Allianz and ICICI Lombard are hot in the race to get into tie-ups with Tesla for insurance in their India vehicles. Now, Bajaj Allianz and ICICI Lombard are in early discussions with Tesla at this point, and no terms have been finalized yet. Sources tell us that the firms are pitching for non-exclusive tie-ups with Tesla, and Tesla sources are also telling us that the decision will ultimately depend on the insurance department working out of the company's Hong Kong or Singapore offices. Now remember, to get a license in India, to get an insurance service provider in India, Tesla needs to get a motor insurance service provider license from the IRDAI. That will take another few months is what the sources are telling us, and only then will they be able to do a proper tie-up with an insurance provider. We have reached out to Bajaj Allianz and ICICI Lombard for their comments on the story, and this is a developing point, so do stay tuned as we bring you more updates.
And significant fundraising moves are underway at SBI. The bank is set to launch a massive 25,000 crore rupee qualified institutional placement, its first equity fundraising since 2017. The bank has received necessary regulatory approvals and has approved the floor price for the issue at 811 apiece. The state-run lender may offer a discount of not more than 5% on the floor price. Right, let me quickly go across to my colleague Shubhana now, who's joining me on the phone line with more. Shubhana, take us through all of the details.
Sure. Yes, so SBI has announced the launch of its QIP today, and they have set the floor price at 811.05 per share. It comes about to 2.5% discount on today's closing price, which is 830.5. Now the bank has said that it can offer up to 5% discount on the floor price. Earlier today, NDTV Profit had actually reported that they are going to issue the 25,000 crore QIP at 2 to 3% discount to the current market price. Now, sources had also told us that LIC could be a major investor in this QIP, and they've also been seeking interest from domestic mutual funds. Now, this is important because in June 2017, SBI had raised 15,000 crores through a QIP, which had a discount of 1% at then the current market price, which was then. And also the QIP is because, so that they can strengthen their balance sheet, their capital base, and also because of regulatory requirements. Now, this QIP has also come as the board today, the board of State Bank of India today separately announced their fundraising plans. They've approved raising up to 10,000 crores through Tier 1 and Tier 2 bonds in the current financial year. And in the financial year gone by in FY25, the bank had raised 10,000 crores each through Tier 1 and Tier 2 bonds and 30,000 crores through infrastructure bonds. So a lot of fundraising moves are happening at SBI.
Right, Shubhana, thank you so much for those updates. We'll continue tracking the story. This is it's the biggest ever QIP in the Indian markets. Moving on to another story coming in now. DLF is making a high-profile comeback to the Mumbai market with the launch of its premium residential project, the West Park Phase 1 in Andheri West, in partnership with Trident Realty. Now, this marks DLF's first large-scale residential development in Mumbai in over a decade, signalling its renewed focus on the city's luxury segment. Anushi brings in more details on this.
Stock in focus in the real estate space would remain DLF, and this is on the back of its big project launch in Mumbai, marking its re-entry into the region again after almost a decade. Now, DLF is set to launch the West Park Phase 1 project tomorrow is what we are looking at the timeline, and this is with a build-up area of 57,000 square feet. The company in partnership with Trident Realty for the same, and this project is expected to be completed by June 2032. Now, this project is being developed in multiple phases, which includes 416 flats across 4 towers in the current phase that we are looking at, starting ticket size being in the range of 6.5 crore. Now, this marks an interesting debut in its MMR region again, since its earlier earlier history as well. The company had acquired a 17-acre mill land plot for 700 crore in Lower Parel in 2005, but because of the global financial crisis and other factors, it had to eventually sell this land parcel to Lodha developers in 2012 for a consideration of 2,700 crore. Now, with this, the company did also point out the overall picture in terms of where the pre-sales and the launch pipeline could be looking like. If you look at the DLF Privana North, it recorded around 11,000 crore sales. With this Mumbai launch, it expects over 2,000 to 2,500 crore of sales. So with this, we are seeing a strong guideline in terms of where the pre-sales number were. FY25, the number was 21,000 crore. This is the expectation that is there for this FY26 as well, 20 to 22,000 crore. So whether there would be an upward revision in the guidance is something that we should be watching out for. As far as where the launch pipeline is concerned, 17,000 crore is the number that we are looking at, which includes the likes of DLF Privana North, Mumbai as well as Goa as well. So this is the overall picture that we are building in for DLF. It's an interesting day we should be watching out for, considering its entry back in the Mumbai market.
Right, Anushri, thanks so much for that. Moving on, a full-page ad in a Hindi daily has sparked a market watchdog alert. NSE has cautioned investors against a Delhi-based unregistered advisory firm that has been running unauthorized stock market services for 16 years. The firm claimed wild intraday margins of up to 500x, zero brokerage and astonishing returns, all without SEBI registration. Charu now joining us with the latest.
Leading boards of the country, National Stock Exchange has come out with a circular saying and cautioning the investors against, getting lured by schemes such as the ones shown in a Hindi daily newspaper sometimes back. Now, this release came after NDTV Profit ran a story about several falsified claims made by unregistered entity called Trading Dost in a Hindi daily. Now, we must understand that NDTV Profit also had a telephonic conversations with the representative of this particular unregistered firm, and we got to know that this is something that is operating from Delhi, specifically the Shadra region. We were also told by those representatives that they have been running the operation since the last 16 years, and this is not something that they are only doing. It is something that is being done by thousands of entities both in India as well as globally. Now, we must understand that it is after this particular report that NDTV Profit came out with, talking about how many years this has been going on for, and that several other players are also into it, and looking at the audacious nature of the front page ad that was run in a Hindi newspaper, the National Stock Exchange, the leading boards of the country, also came out with a circular yesterday night talking about how investors must protect themselves by not engaging with such schemes. So let's see how further developments on such cases roll out, because as we exclusively reported some time back, several YouTube channels, Telegram channels and other social media platforms are used to lure investors into such schemes, and it is something that the SEBI as a regulator is also investigating and is also concerned about because of the enormous volume of such instances. So let's see how the regulatory crackdown on these things continue and how many of more such stories we can look at, because clearly volume is the issue.
Meanwhile, Tech Mahindra and L&T Technology have come up with their Q1 FY26 earnings today. Tech Mahindra on Wednesday posted a 33.9% rise in consolidated net profit for the April-June quarter to 1,140 crore. The company also witnessed a slight dip in revenue, which came in at 13,351 crore, down 0.2% compared to the previous quarter. My colleague Jasmeet joins with more details on this.
Tech Mahindra results are out, and here what the number says in terms of key highlights for the company for the Q1 results. Firstly, the numbers are in line with the estimates. Secondly, margins have improved by 70 basis points, while this adds on to the management commentary earlier of reaching 15% margin by FY27. This shows that the management is on track to achieve that margin by FY27. While thirdly, the communication, being the largest sector of the company, has reported a growth of 3%, while communication contributes roughly 33% of the overall revenue. While fourthly, the new deal wins of the company have performed at $809 million, while the estimated range was between $600 to $800 million, while that's a positive again. Lastly, the revenue in CC terms have shown a slight downtick by 1.4% on QOQ basis. Now let's quickly look at the numbers, or how the numbers have performed. Revenue is down by 0.25% at 13,300 odd crores, while the EBIT stands at 14,000 odd crores with an uptick of 7.12%. While on the other hand, EBIT margins are up by 76 basis points and currently at 11.06, while the estimated was 11.01%. On the other hand, lastly, the net profit is down by 2.14% at 1100 odd crores. While this is all for Tech Mahindra review.
Jasmeet, stay with us because Wipro is also set to announce its much anticipated quarterly results tomorrow. What are analysts predicting for the IT giant's performance on that one?
Well, right, thank you for that. Here's a quick preview for the company as the results are expected tomorrow. As for FY21 for Q1, the revenue is expected to fall by 1.8% and remain at 22,000 odd crores. Compare that to 22,500 odd crores in the previous quarter, while the EBIT is expected to fall by 3% and the margins are expected to remain around 17.07% versus around 17.3% the previous quarter. When you look at the net profit figures, it's expected to fall by 9%. Now, management sees a CC degrowth of 3.5 to 1.5%, which they had communicated in the last quarter. So that's something to watch out for. While HSBC expects the CC growth to be at the mid-range of -3.5 to -1.5. While lastly, the EBIT margin, the margins have improved steadily over last 4 to 5 quarters. So that's something to watch out for. Lastly, the brokerages expect 40 to 50 basis point decline in the margin on QOQ basis. Lastly, margin lower led by the lower utilization, same provision for the client specific count. So these are the things to watch out for the results tomorrow.
Thanks so much for that, Jasmeet. And if you are in Karnataka, your next weekend's movie plan might just be easier on the pockets. In a major move to make cinema more affordable, the Siddaramaiah-led Congress government in the state has proposed a price ceiling on cinema tickets. This would ensure that no one pays more than 200 rupees per show, regardless of the theatre or film language. Himakshi now joining in with more on this.
So it's lights, camera and budget-friendly action in Karnataka. The state government has dropped a blockbuster announcement that movie ticket prices across the state, including plush multiplexes, are now officially capped at just 200 rupees. So yes, your popcorn may still cost more than your seat. This move follows Chief Minister Siddaramaiah's promise during the budget speech, and it's now official that after amending Rule 55 of the Karnataka Cinemas Regulation Rules 2014, a new sub-rule ensures that 200 rupees is the maximum ticket price, inclusive of all the amusement or the entertainment taxes, no matter the cinema or the language. So while cinephiles are thrilled, especially fans of Kannada and other regional films, multiplex chains seem less amused. So on social media, concerns are popping like popcorns. They are worrying that with high-end infrastructure and operational costs, can they really keep the reels rolling profitably? Now, but the government actually insists the move that it will make more, cinema inclusive, affordable, and will breathe fresh life into the regional filmmaking. So whether you're watching a big banner Bollywood flick or a soulful Kannada indie, your wallet will thank you. But as the internet debates, will multiplexes adapt or push back? So only time and ticket counters will tell. For now, Karnataka says that picture to abhi baki hai, but no more than 200 bucks.
Seems like a tempting proposition. Thanks so much for that, Himakshi. And in a significant development following the global controversy over Prada's Kolhapuri-inspired sandals, a high-level team from the luxury fashion house has arrived in Kolhapur in Maharashtra today to initiate groundwork for potential collaboration with local artisans. Now, this group, comprising of Prada's core technical team, is currently in the city to evaluate the traditional production process of the Kolhapuri chappals. Designers are expected to spend the entire day and, of course, the rest of the evening meeting artisans, cooperative heads and stakeholders to understand the intricacies of the craft. The team departs tomorrow morning.
कोल्हापुरी चप्पल की जो उनके रैंप वॉक के बाद कंट्रोवर्सी तैयार हुई, उसके बाद में महाराष्ट्र चैम्बर ऑफ कॉमर्स से प्राडा से संपर्क किया था कि ये कोल्हापुरी कला है, ये भारत की कला है, इसको उन्होंने एक्नॉलेज करना चाहिए। उन्होंने लिखित स्वरूप में इसे मान्य किया, एक्नॉलेज किया और उसके पश्चात ये कोल्हापुरी चप्पल कोल्हापुर के कारागिरों से सीधे प्राड़ा खरीदी करे, जिसका फायदा यहाँ के कारागिरों को, ऐसी भूमिका चैम्बर ने उनके साथ हुई वीडियो मीटिंग में रखी थी। प्राड़ा ने हमारी विनंती स्वीकार करके आज प्राड़ा की ग्लोबल जो टेक्निकल टीम है वो कोल्हापुर में आई है। उनके ग्लोबल डिजाइन हेड है फुटवेयर डिवीजन के, उनके ग्लोबल टेक्निकल हेड है, जितने भी उनके टेक्निकल डिपार्टमेंट के ग्लोबल चीफ है वो सारे आज कोल्हापुर में 6 लोग यहाँ आए हैं। और ये पहली बार ऐसा हुआ है कि प्राड़ा जैसा ग्लोबल ब्रांड ने कोल्हापुर जैसे छोटे शहर में आके ये चप्पल बनाने वाले कारागिरों से सीधा संवाद करने का प्रयास किया है। ये उनके चप्पल बनाने की प्रक्रिया का मुआयना कर रहे हैं, उनके प्राड़ा के टेक्नोलॉजिकल जो रिक्वायरमेंट्स है उस हिसाब से ये चप्पल कैसे बन सकती है इसके बारे में वो यहाँ के कारागिरों के साथ संवाद कर रहे हैं।
Bollywood superstar Salman Khan has sold his upscale apartment in Bandra West in Mumbai for 5.35 crore. The apartment spans approximately 1,318 square feet across a built-up area. The purchase also includes 3 car parking spaces in the high-end residential building. According to reports, the documents were reviewed by squareyards.com, which is a real estate sale website. This was also reviewed on the portal of IGR or the Inspector General of Registration. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
I went to IIT Mumbai, Sundar Pichai went to IIT Kharagpur, but there is another colleague of mine and he went to IIT Mumbai. He is releasing a book, a biographical account about him and how he has used the principles of the Bhagavad Gita and ancient Vedic spirituality to apply in his corporate career, which was quite centered around swinging markets which are not at all in equilibrium, as you know. And he went to the same hostel as mine, Hostel 6.
And who is this?
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज और देखती है यहां तो सवालों का मायाजाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है, बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make in our categories that we have been supplying to our defense forces some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. So let me first start off by understanding how the pricing environment is evolving, both in terms of health as well as motor, which is obviously the two largest segments that you have. So give us that perspective to start off.
So good morning to you and good morning to all your viewers.
Good morning, sir.
I think, so let me again just put this in context. I think if you look at the market currently is running at a combined ratio of about 112%, which is to say that against 100 rupees of premiums that you're collecting, all of your obligations or outflows put together, the industry is kind of losing roughly anywhere between 12 to 13%. So obviously, in that sense, when you look at it, the market has to get far more disciplined insofar as the pricing environment is concerned at an aggregate level. Now, let's break it into specific segments. To your point on what's happening on motor, what's happening on health. Let's take motor first. Now, while I gave the industry combined ratios at an aggregate level, if you were to look at motor as a category, industry is actually kind of slightly more worse off because as we speak, for the last year ended gone by, the industry actually reported a combined ratio of 124%. So this is obviously in that sense quite significant insofar as underwriting losses are concerned. And in the backdrop is where I think again the industry has to kind of course correct itself insofar as the pricing environment is concerned. So hence, as we speak, the market continues to remain aggressive, and that's the reason why we believe at that 124% levels of combined, it cannot be sustainable. So players have to kind of improve pricing in general. And within that, in the current year specifically, there is also a regulatory stipulation for companies which are exceeding the expense of management threshold to come within the limits that are laid down. So hence, there is also an expectation that the pricing environment should get better as we kind of head into particularly the second half of the year, largely to kind of meet compliance with guidelines. And the last part that I would say in the context of motor in the with respect to the pricing regime is, I think clearly there is a equal seek insofar as increase in price for motor third party. When that will get happen, very difficult to kind of comment. But honestly, as an industry, we have sought a increase in pricing for motor third party. To your point on health, I think as ICICI Lombard, I think we have always kind of maintained that on an annualized basis, we are okay to run the book at a loss ratio in the range of 65 to 70%. And if you would have seen for the year gone by, that number stood at roughly about 68% or thereabout. Within quarters, obviously there will be, let's say, reflection of loss ratios which could be plus minus within that range. But at a company level, from an ICICI Lombard standpoint, I think the range that we are comfortable operating at is between 65 to 70%. And there, I think we are quite comfortable insofar as price is concerned, particularly in the context of ICICI Lombard.
Point taken, sir. Sir, so when does growth start to kick in? Given all of this, what is your current viewpoint? What's the pulse feeling like?
Look at quarter one gone by, right? I think even if you look at, so there is obviously this element of 1 by N. If you recollect, I think we did speak about even in last quarter. This was a regulatory change that had happened in October of 2024, which is likely to kind of subsist for one more quarter, as in for quarter two. We did see the impact of it in Q1 as well. But leave that aside. Even keeping that aside, the industry has kind of grown at roughly at about 8.8%. Which I would say is reasonable insofar as given where we are in terms of the overall scheme of things. But if you were to break down in terms of categories, most of the segments have grown almost at similar levels, particularly when you look at motor and health at an industry level. And commercial lines, if you recollect, last year did see stress in pricing. Now that's come back, which is a good news. And therefore, the expectation is pretty much similar, I think, as what we have maintained. I think the second half of the year will obviously be out of the 1 by N prescription. So hence to that extent, one should logically start seeing normalized growth coming in. If you look at the long-term averages, I would continue to say that general insurance industry should continue to exhibit growth in that range of 15 to 20% from a structurally long-term perspective. In this year, I think there are both headwinds and tailwinds, and therefore to that extent it will be reasonable to expect the industry to grow in a high single digit to maybe early double digit numbers.
Okay, high single, early double. What should we expect on the combined, sir? Because the combined doesn't, or rather there seems to be some amount of difficulty in it coming off. As pricing likely improves, can the combined improve, and by how much by end of this year?
Yeah, that's always a difficult question to answer, right? But
yes, absolutely. I don't envy you, sir, but
yeah.
Yes.
So, but having said that, again, let's look at how ICICI Lombard has kind of put out their numbers for Q1. Again, I would just kind of give the numbers because what gets reported on a published basis may not be comparable with the Q1 numbers last year. Again, for the same prescription of the N and the 1 by N related impact. And I will confine myself right now on a like-to-like basis, which is on an end-to-end basis for Q1 last year and Q1 current year. Q1 last year on an end basis, we reported a combined of 102.3%. If you'd have seen the numbers for ICICI Lombard for Q1 this year, which is for Q1 FY26, again on a like-to-like basis on an end basis, that number stands at 102.2. So actually, we have been able to make a moderate improvement in the overall combined numbers. However, what gets published is more on a 1 by N basis, where the number stands at about 102.9. So directionally, again, as I said, on a like-to-like basis, we have been able to make an improvement in the combined ratios. And exactly to the point that you originally asked, as in terms of how the pricing environment is playing out, as the industry starts to kind of respond well in terms of improved pricing regime and also overall growth getting stimulated, logically, we should be able to kind of further see an improvement in our combined by the end of the year. And that is exactly what ICICI Lombard has been exhibiting pretty much every year since the last 3 years in terms of improvement in combined.
So this very strong investment income, that's largely led to the profit beat. And I know maybe you can't talk about the beat in profitability, but that is how the analyst community views it, right? So can that sustain? Where is that coming from? Give us that color.
Yeah, so again, I think I'll put this in context. I think from an ICICI Lombard standpoint, I think the good news is I think a large part of our business is significantly granular and retail. Now that ensures that as a company, we are able to have regular streams of cash flows, which kind of takes care of the obligations that we may have on a day-to-day basis. And therefore, from an investment standpoint, I think general insurance is a business of float, because the beauty of the business is you get money on day one. Until the time the various obligations doesn't get paid out, you are able to kind of make that investments in the right calls. And that is exactly what ICICI Lombard has been kind of doing with the float that we have got generated. And particularly in the last couple of years when the interest rate environment was quite favorable, as in the rates were relatively higher, we were able to kind of lock some of the investment cash flows that we got in long-dated securities. And as we speak, the interest rates, thanks to the regulatory actions, I think there has been a softer environment as we speak. And obviously, some of those calls have actually helped us to play, particularly in the fixed income securities, which we have a relatively large part of the exposure. And hence, to that extent, that obviously kind of helps insofar as our investment returns are concerned. Equally, ICICI Lombard has always been a firm believer of investing in equities. Our current proportion of equity mix to the total investment asset stands roughly at about 14-15%. And there again, thanks to the markets, it has obviously given us an opportunity to pick up the right stocks. And that is the reason if you see the unrealized mark-to-market gains on the equity and the fixed income book put together, collectively that number stands at 30th June at almost about 25 billion rupees, 2,500 crores. So that's how we have been. So, and again, generally, we prefer to look at it more from a longer term standpoint. Over the last 24 years of our existence, we have tried to generate a realized return which has been kind of ranging between 8.5% to 9%.
Some motor TP is the one big possible boost that you could get in terms of pricing. How likely is that?
I think we will all wait for the final notification to come through.
Sure.
And at that point of time, I'm sure we will be able to figure out as to what that price change is. But just to kind of put this in context is where I would kind of, which is what we called out even in the earnings call last evening, as in to say that when we are looking at quote compensations, clearly we see an increase in the average claim awards, because largely this is the impacted individual happens to be a victim on the street, and therefore to that extent the courts are generally far more generous in terms of compensation. So hence, from a general insurance standpoint, I think there has always been clearly this factor has been looked at, and therefore we have sought for a price change. How much does it finally get translated into is something that, as I said, we will have to wait for the final notification. We'll be happy to discuss at that point of time.
So on the retail side, the improvement in loss ratios largely led by group. I want to understand sustainability of that number. And on the on the health side, I beg your pardon, group is leading the charge with regard to loss ratios. What happens in retail, sir? Give us that color as well.
Yeah, so again, I think I'll just kind of put this in context. I think when you look at, let's pick the corporate health or the group health segment first. Even in our earlier calls, what we had always talked about is this book will relatively be very high insofar as the loss experience is concerned, because even we are largely working with corporates, and therefore to that extent they will equally understand what levels of pricing should the risk be carried at. So generally mid-90s is the loss ratios that we have largely spoken about in the context of corporate health. And even if you would have seen for the Q1 gone by, our corporate health loss ratio stood around that range of 94-95%, roughly what 95% is, if I remember the numbers correctly. And on the retail, I think, which is what I kind of mentioned earlier, generally the range that we have spoken about is between 65 to 70%. For the last financial year gone by, because ideally it is always better to look at these numbers on a year-on-year basis, because experiences could kind of get varied in between quarters. So for the year gone by, we ended up reporting a loss ratio on the retail health at about 68%. And that's the reason I said the range that we are comfortable with on the retail health side is between 65 to 70%. And the good news is, I think the product Elevate that we launched in Q2 of last year, that continues to do well for us, both in terms of distribution expansion and the number of customers that we are able to take on board. And as of now, the experience of the book, which is largely about close to a year since the time we launched, is looking quite favorable. And therefore, at this point of time, we stick to that loss ratio range on an annualized basis between 65 to 70 for retail health.
Ma'am, I wanted to start off by understanding growth, because you had guided last year around an 18% odd growth. You know, basis commentary that I have been listening to, that seems to have, there seems to be some tepidness in FY26. Give us what is happening in the marketplace, and also give us the perspective on what that growth number will be therefore for FY26.
Yeah, thank you for having me on your show. Let's put some of the numbers out there. What we had mentioned at the start of this year is that growth in the first half of last year in FY25 was in the 30s. So for example, Q1 growth was 31%. And against that, we had said that growth will be in the early teens, and we will grow faster than the sector. And I think we have delivered well on both. So our growth has been 12.5% on a APE basis, as well as market share expansion of 70 basis points. And for the first time, we have crossed almost 12.1% as market share. And also, if you look at the 2-year CAGR, the 2-year CAGR has been a healthy almost 21.5%. And you will agree that is more than a healthy number. So we will continue to stick with our both aspiration as well as, in a way, internal mandate, what we've been delivering in cohorts of 4 years, of doubling every metric in 4.5 years. So nothing has changed as far as that is concerned.
Point taken, ma'am. And is there a downside risk at all to this growth except the higher base? Is there absolutely any concern that you're seeing?
Only macro. The macro situation is still evolving. Consumption is still sluggish. Some of the trade situation is yet to pan out and settle down. So nothing more than the overall macro, little bit of sluggishness there.
Point taken. One of the key pieces is the change in mix over the last couple of years. How much of a concern is that for you, and how quickly does it unwind? You have guided that it will unwind at some point this year, so I want to put that out to viewers. But how quickly does it unwind, and what's happening? Give us that perspective.
Actually, the mix is no longer an issue because we are able to, over several time periods, fairly nimble to adjust the mix based on both customer preferences, macro situation, and our own objectives. And of course, what is right for the customer. So let me just deconstruct quarter one mix. Quarter one mix saw an uplift in protection. And that's always something that we have been driving. So protection grew by 19% versus the 12.5% overall APE growth. Annuity grew by 25%. And again, that was a more than a healthy number, holding our market share. Also, protection on a 2-year CAGR basis continued to be very robust, and the sum assured growth as well. As far as participating products are concerned, there we grew more than double, so more than 100% on the back of new product launches as well as relaunches. I think what we're trying to do is that triangulate both objectives of growth and margins and the right customer product fit. And I think we've been we're more than happy in the way it has panned out.
Okay, ma'am, that brings me to the margin question. Margins have been at the lower end of your guidance for a while now. When does it start to pick up? Let me just get to the elephant in the room.
So I would like to say that the margins have picked up, and let me deconstruct.
Sure.
Last year, first quarter of last year, margins were 25%. We, as a sector, had to recalibrate our business model with the new surrender charges, which came into effect on 1st of October last year. So the impact of surrender charges, even if I did no change to any of my inputs in my business, it would have had a 30 basis points, which means my starting point on margins was 25% less 30 basis points. So my starting point itself this year was 24.7%. Versus 24.7% margin, I have delivered 25.1% margin, which means it's a 40 basis points increase in margins, despite all the bearishness or the sluggishness that we spoke about earlier. So really the margin increase has already started, and as a sector I am of the belief that over the next 3 to 4 year period there will be enough levers for a slow but steady increase in margins while growth comes back.
Got it. And how much of that can you capture? So ma'am, you've done 40 bips as you correctly flagged to us. Give us the perspective as to where it goes from here. So maybe FY27, FY26, you've guided for a year where margins will go nowhere materially. But is FY27 the year where we see an inch up?
Difficult to put to peg on a particular year because there are 2 or 3 factors. One is the macro, second is regulatory. And third is any one-off. We've had COVID, we've had a political situation and so on. So all things being equal, I think doubling every 4 years is something that we will look at. And that will be a combination of top line as well as margin expansion. It will be both.
Got it. So what you're trying to say, ma'am, is VNB, which is value of new business, will double every 4 years. That's really the aspiration. The margin number is an outcome. And the 18% growth CAGR will continue both on top line as well as VNB. Is that the right way to look at this?
Spot on, yes.
And maybe over the next year or so, at least FY26 will be slightly softer overall. That seems to be the picture.
As far as the visibility today is concerned, first half will be very similar to quarter one. And just to summarize, it will be in the kind of growth levels that we have seen. Although June was better than May and April and so on, so slightly getting better, but nevertheless, depends on the overall macro sentiment. As well as the base effect, like I mentioned, for us, 31% growth. Against that, the base effect also is there. Second half will be, at least in terms of growth percentages, should be better, and thereby evening out, like I mentioned. At the same time, we are fairly confident that if growth comes back, our growth will be faster than industry growth, and hence there will be market share expansion, like we have shown in Q1.
Absolutely. Okay. Ma'am, and this is maybe a question to sidestep, completely different tack that I'm taking. Is there a penetration issue in the industry at all? You have spoken about how you're going deeper, but just a growth number, and again, I'm saying I'm completely shifting tack. Give us that perspective. Is there a penetration issue at all, or do you feel that no, penetration is not a challenge at all?
So penetration, life insurance penetration has actually come down. This is in our regulator's annual report. So it's not wrong to say that levels of penetration need to materially go up. I would say that a few things. One is if we have more data, especially in tier 2 and 3, and that's something that the avatar of Bima Sugam has been trying to do. Then that just means that our visibility will be a lot more. Second is more and more reinsurance capacity will help life insurers. Third is in terms of some of the innovations on products, shorter tenure, bite-sized products, and so on, will help both the manufacturers test out whether these products are viable, as well as take it to the last mile in terms of increasing penetration. At the same time, if I just were to look at HDFC Life, in Q1, 70% of my customers onboarded are new to HDFC Life. That's not to say that they have no policy, but in all probability, a large chunk of them would have had no policy, given that HDFC Life is a market leader in this. So it's not that it's all doomsday. We are adding more and more customers. We are selling to first-time customers, like the 70% number. But can we do more? Is there a lot more to be done? I think so.
Is this also due to pricing going up, ma'am? Give us that perspective, and how well is it getting absorbed? Is there some bit of a backseat that volumes have taken because pricing has inched up?
So, India is one of the cheapest in terms of rates of insurance, especially when you compare pure term. Because in pure term, there is nothing else that is sitting in there as a unique feature. It's just, pure mortality cover. And India is cheaper than, many countries that have much better levels of mortality, so lower death rates. So I don't think realistically that pricing is an issue. There are some other issues. It's not issues per se, but I think as awareness, accessibility, and affordability, the 3 A's inch up, there will be a propensity to buy more and more life insurance. I think we are at that inflection point very shortly, wherein people will start realizing the need for at least health and pure term protection. And no longer see it as an expense, but as a means to invest in the well-being of their families. And we are there. I think $5,000 per capita GDP tends to be a sweet spot, and we will inch up there.
Vinay Jaising, CIO and Head of Equity Advisory at ASK Private Wealth, Johnson right now on the show in his new avatar. Vinay, great talking to you. It's been a while, but thanks for taking the time out.
Really appreciate you taking us out.
No, not at all. Vinay, constructive currently or skeptical? Because there are too many moving parts, as usually there are, but right now even more so.
So pretty constructive, more so on stocks than on the indices, and largely the reasons are pretty simple. If you had turned back the clock last year, you had one engine firing the Indian markets, which was retail. All of a sudden, with the currency being where it is, virtually flat on a year-on-year basis versus the dollar, and the DXY having moved down by 10%, you've seen FIs in the last 2-3 months put as much as $4 billion. So now you have two engines firing the Indian capital markets. So, these are two solid reasons. The third solid reason to be constructive is you've seen crude prices correct by 15 to 20%. which is again good news or music to the eyes of, the Indian coffers. The fourth reason is you're probably close to the end of earnings cuts coming up for estimates for EPS for most companies. Finally, you've seen the banking system flushed with liquidity. So all these, are very positive for the capital markets. One clear, not so positive moving part is valuations, because if you see the last 3 months, the Indian small cap and mid cap are up between 15 to 25%. Not just us, but MSCI World is close to peak levels today. So valuations are not as attractive as they were earlier.
So valuations are not attractive. However, if you have to look at India in terms of resilience, do you think we are way better off as compared to other emerging markets then? And with the kind of fund flow movement that is expected to happen as well, where would you then find pockets of opportunity right now?
So 3 questions. First, valuations are not as attractive, but India's resilience clearly is great. If you look at the incremental GDP India is adding on to the world, it's somewhere to the tune of 10 to 20% based on the world growth being 1 to 2%. Take an average number of 15% of the incremental world's GDP coming in from India. That's a very big sign. In terms of profit pool, it's just 1.5, 1.6%. And in terms of inflows, last year was negative, but average is about 1.5%. So you can see a lot of inflows come into the country. Second point, if you look at indices, most indices in emerging market have moved India up from 6-7% to as much as 18%. And at the same time, if you look at the data of Indian FIs in the shareholding pattern, that's gone down from a peak of 20 to 16, again, a 12 to 14-year low. So, this also gives you the fact that, FIs are underowned the country, and the GDP is growing pretty well. One last indicator, which is very pro-India, is if I had to just look at the 10-year interest rate of India versus the rest of the world, or let's talk about US currently. 6 years ago, it was 6%, the interest rate differential between India and US. For the 10-year. Today, it's as low as 1.8%. So it also tells you the risk premium for India has come down substantially.
Okay. So that's with regards to where, India stands in terms of resilience, the key positives that you should be looking at. Let me talk to you about individual sectors. Right now we were just talking about how real estate as a sector is seeing some good numbers in terms of the pre-sales data that has come in for the first quarter of FY26, but a lot of negatives that were there in FY25. Would you say this is going to be a space which could be looked at from an investment perspective, taking into consideration the downtick in terms of performance? And if so, where would it be? Would it be affordable housing? Would it be the mid-segment? Or would it be luxury?
So my focus would be on affordable housing. Again, a couple of reasons. One, interest rates in the country are coming down. Second, you've seen the Indian budget focus a lot more on SOPs being given to affordable housing. And third, the fact that, India is moving up on the per capita segment, that's where the demand would be incrementally a lot more. And finally, if you see the supply is relatively in the last 2-3 years limited in the affordable housing segment. So for me, it would be the affordable housing segment space. And out here, obviously, you have NBFCs which are there. And then, you can add construction or cement companies also into that foray.
Vinay Jai Singh, we'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time.
Cheers. Thank you so much.
Right now across the world, even Harvard is actually realizing that consciousness is a very important principle, and Harvard gives courses on mindful leadership, on conscious leadership, on conscious businesses.
जनता के पास सवाल ही सवाल है, जवाब ढूंढने को वो देखती है न्यूज, और देखती है यहां तो सवालों का मायाजाल है। ऊपर से ये अलग फाइट है, कोई पूरा लेफ्ट तो कोई पूरा राइट है। बीच में मुद्दे के साथ कौन है, जनता को जवाब चाहिए। इसीलिए सवालों की परेड नहीं, मैं लाऊंगा खबरों की कचहरी। मैं शुभांकर मिश्रा, मेरे साथ देखिए कचहरी रात 8 बजे सिर्फ एनडीटीवी इंडिया पर।
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about
Alex, you haven't completed that stuff. The guest is not fish.
Stop. There's too much stress. How do you guys deal with this? I need to go and find that monk that